So again, welcome to Istanbul. I mean, as a local, it's great to welcome you in this beautiful city. And yeah, in this panel, we will talk about security and risk considerations when adopting stablecoins. So before starting my question, like before start asking to my guests, I'm gonna kindly ask them to introduce themselves. So we can start by you, then we can go forward to the Watson. Yeah.
Sure. Hey guys, my name is Nick Fett. I am one of the founders of Teller. Teller is a decentralized Oracle. We provide price feeds, cross-chain messaging, kind of whatever your Oracle needs are. A lot of times just stablecoins.
Hey guys, I'm Seraphim. I'm head of growth at Athena. We do delta neutral stablecoin. You take staked ETH and you short ETH perps and you get like a cool yield profile. So that's what we do.
Hi, I'm Money Supply from Block Analytica, and we specialize in risk management for decentralized stablecoins and on-chain credit markets.
Hi, I'm Watson Fu. I'm the head of market risk at Gauntlet. We focus on protocol optimization through quantitative methodologies for both risk management and incentive optimization.
Awesome. So let's start. Our first question is related with some possible risk and risk of some crash. And we experienced lots of stablecoin crash so far, and the most famous one, the Luna crash. And some people in the industry could guess that was gonna happen. So what do you think about if we're doing well right now in terms of the most common protocols and the stablecoin systems, or do you even guess some possible threats right now in terms of some possible collapse or maybe some more basic stuff? So basically, I'm wondering if you see some possible dangers in both DeFi protocols related with stablecoins or also some fight-back stablecoins. So maybe we can follow the reverse order this time, and yeah, we can listen. Yeah.
Sure. Yeah, I think even earlier this year, if we just take the Terra Luna UST situation, I think the sort of contours of exactly what happened were already shown to have a lot of intricacies in the ecosystem we have now. And that's also highlighted with what we saw in March with USDC, right? It's a completely different scenario in terms of what the risk factors were, what the considerations were, and what market participants did afterwards. I'm not going to sit up here and say I know all of the potential issues of stablecoins and risk management regarding stablecoins. At the same time, I think that a lot of market participants developed strategies and learned a lot from understanding how to mitigate risks around stablecoins. I know it's a bit sort of hand-wavy of an answer, but I think in general, security and risk management with stablecoins has come a long way, and then again, the ecosystem is sort of learning as we go.
Yeah, I think we have learned some important lessons from Terra Luna. Like one example is that endogenous backing, like using your own governance token or whatever as backing, is no longer like really sort of accepted as a safe practice in the space. So I think that's like a really important advance that we have. Like Frax, for instance, they're moving away from having their token collateralize the stablecoin and just towards like full 100% backing. You still see occasionally people create a model that is based on endogenous collateral. So like an example of this is Thorchain has like a new lending product, and under the hood, it's basically backing the loans with the Rune token, which puts it at pretty high risk in certain respects. But I think we have learned a lot from Terra. I think like the next wave of risks that I see happening are more around real-world assets. So just because it has quote-unquote 100% backing doesn't mean that the backing is like actually suitable for the stablecoin. And one recent example of this sort of like going wrong is there's a stablecoin called Tangible USD that's backed with real estate, and it's interesting in a lot of ways, but you can't sell real estate really quickly. It's not very liquid. So when people wanted to, get rid of tangible USD, or they lost confidence, they weren't able to get all of that backing, back to back the stablecoin immediately. So it's fallen below peg. So I think there's probably going to be more risks in real-world assets going forward.
Yeah, I think we're running out of stablecoins to collapse at this point over the last 2 years. I think Terra Luna was obviously important. As you guys mentioned that backing by your governance stablecoin seems to be, your governance token seems to be out of fashion. Although there's quite a few that survived and still okay, like synthetics, for example. But I think even they're starting to shift to multi-collateral, I think. So I think another important thing that happened last year was BUSD. It was not the same as Terra, obviously, but it did show that basically what happens is you should not keep your money in America. I mean, obviously, a lot of these stablecoins, Tether, USDC, they hold money in treasuries, which has to be somewhere in the States. But at the end of the day, if you are literally in America officially, it's probably not a good idea. So that was a good lesson. Another lesson from that was basically that they're not going to take your money away. That was kind of interesting. Even though this SEC hates CZ, they still allowed you to redeem your kind of stables, your assets from BUSD. So that was like a good kind of way for us to understand what the risks are of having an onshore stablecoin. But yeah, just get out of the States. That's kind of what I've learned from that.
Yeah, so kind of echoing what they would say, to kind of paint the landscape. This is Stablecoin Summit. You probably all know there's like centralized stablecoins, USDT, USDC. The risk there, it's almost all regulatory risk. Are the U.S. banks going to shut something down and cause a collapse? That's more like systemic risk for all of DeFi that we have to worry about. On the decentralized stablecoins, as they were saying, the risks mainly come in the form of what collateral are you using, and then there's also Oracle risks and Oracle centralization that maybe we can talk about a little bit too. Yeah. But yeah, the biggest kind of upcoming ones that I see, I see a lot of people actually backing things with the real world assets, but then everyone that we talk to is going to put Steth and wrapped, restaked ETH and everything like that, and there's probably going to be a lot of systemic risks that kind of come from that. So not to mention just how you price these things and how you sort of risk adjust them inside of a stable coin.
Yeah, thank you. The following question will be closely related with censorship mechanisms in stablecoins. And as you probably know that the most common stablecoins like USDT, USDC, or like Binance USD, TrueUSD have blacklisting functions in their contract. And yeah, they can blacklist whoever they want. And as you know, these are some central institutions. So what do you think? Isn't it too dangerous to allow some central institutions to blacklist someone in the industry, and specifically Web3, which are meant to decentralized? And yeah, we can start by Nicholas Watson this time.
Yeah, sure. Yeah, I think that question is pretty philosophical and existential to a lot of individual sort of belief of the ethos of crypto. I think my personal viewpoint is also slightly biased, coming from a traditional finance background in the United States. I think that, like Monet just said, and Seraphim, I think the regulations sort of play a huge factor in how I sort of think about stablecoin and the general sort of stablecoin economy growing. And what I mean is, if you sort of look at the history of US regulations through Dodd-Frank, at this point like FSOC, various committees, even if you look at Europe with MiFID II and specific reporting requirements, I think that blacklisting is partially against, yeah, like I said, the ethos of what we believe in terms of decentralization. At the same time, if we want mass adoption from large sort of US institutions and sort of getting the economies of scale and having large players step into the ecosystem, I think it's relatively important to understand sort of the guardrails, right? I think Web 2, the adoption, the general initial use case was for some illicit activities. I think you see the same in Web 3. As we develop, as we mature as a space, I think it's a necessary evil, I guess you could say.
Yeah, I'd co-sign that. I think if you're going to have, a centralized company issue a stablecoin, you have to kind of play by the rules of whatever banking sector that you're kind of affiliated with. So I think Tether and USDC having a blacklist function, it's unavoidable, and in a way you could even look at it like we're kind of appeasing the regulators, we're keeping the government happy. The sort of like risk factor that I keep an eye out is Tether, Circle, they've blacklisted plenty of addresses, but they've never blacklisted like DeFi protocols or multi-user pools. Sometimes you'll see somebody hacks something and they steal some tethers and then they put it into like a liquidity pool like Curve or something. And you never see Tether blacklisting the 3 pool or something like that. So I think that's like kind of the red line where if you see some of that like sort of indiscriminate multi-user pool getting frozen, then we really need to like reassess exactly what we're doing here and what's a viable alternative. But we've not gotten there yet, and hopefully we never do, and we can just kind of keep everything in the sort of like balance that it is now.
So maybe in this point, I can share some statistics to make things more concrete for both our audience and our speakers. When you analyze the on-chain data, you see that the things are a bit serious. Tether has blacklisted more than 900 users only on the Ethereum mainnet, where Circle has blacklisted like 150 users on mainnet. So, the main point of mine is, which I'm trying to make sure, or make it more clear for myself. Are these numbers should these numbers afraid us, make us afraid, or these numbers are there, but they might have some reasons for themselves, or so that's why we should be fine, or we should be relaxed. But yeah, as Watson said, okay, this is this is not coinciding with the ethos of the philosophy of the ecosystem, but maybe you might have some contrary opinions, because these numbers seem like we have like some serious problems, but maybe the thing cannot be in that way. So I just wanted to add some numbers to make it more concrete.
Yeah, I think most things are done for a good reason, right? Doesn't mean it's okay. I think with blacklisting, I understand, because Tether have this very difficult choice of, are they going to make $3 billion a year, or are they going to go to jail? And it's really hard to decide, but I see what they've done, So I think the more interesting slippery slope that comes from this is more about what you mentioned about DeFi protocols being banned, and also, if you remember last year, we had the merge. And basically, if Tether Circle decided we want to stick to proof of work, they could have done that, right? But they didn't. But ultimately, there could come a point where somebody says, you know what, the US government could come to them and say, we want a KYC version of Ethereum, you have to choose that one. So they could do it. I think they're not banning Curve and Uniswap purely out of goodness of their hearts, pretty much. And if somebody came to them and said, that's important to us, you have to close it, they would probably do it. And the reality is we just need to create more decentralized alternatives. In the meantime, that could work better than what we've done so far. Otherwise, we're going to end up kind of in that kind of situation. But I think there's a silver lining here with even centralized stablecoins. Basically, it's a trade-off. We have to blacklist people and all that stuff. But if the stablecoin market grows a lot, we basically fund the US government. At this point, it's like $130 billion worth of treasuries or something that offshore stablecoins hold, right? That's like the 20th biggest country or something like that. If we 10x this cycle again, we'll have as much treasuries on our balance sheets as Japan or China. So then we could literally call shots and say, we want this, we want that. We just need to get to the point where we literally are the biggest funder of the US government and just bid our time, and try to keep cool before that.
Yeah, no, that was great. Yeah, like we'll hold the fork choice rule for the U.S. government, right? No, it's interesting. I think a lot of the blacklist stuff gets kind of solved once you actually get some privacy in some of these systems. It's sort of sad that we don't have any privacy on top of most of these stablecoins. I think over the next few years, we're going to start getting some of that. Hopefully, we have decentralized stablecoins with some privacy, and they can start kind of competing with some of these other ones.
Okay, thank you. So, like, also, this question is a bit more related with the reserves, and like because in specifically fight-backed stablecoins, they're claiming that they're holding some reserves which should be greater than or equal to the market cap or the supply of the token. So here the fact that these reserves are not accessible in a live manner, so we have like we know about them when they publish a audit report about their reserves. Does it sound then dangerous to you because of they have minting and burning functions? They can use it however they want to use, like before or after the audits, and there are lots of rumors in terms of like some central institutions minting lots of tokens after the audit, burning tokens before the audit. Obviously, these are all rumors. We have no idea. We have no concrete data about it. But just philosophically, or just we're doing a thought experiment. Does it sound dangerous? The effort of making things transparent is worth to sacrifice something like capital efficiency, which I'm gonna ask in another question about stablecoin trilemma. But in this specific question, what do you think about the non-transparency in reserves of fight-backed stablecoins? This time we can start with
Yeah, no, I mean, obviously it's a risk. I think it's probably, the US government at least will probably put stablecoins under some sort of banking regulation here shortly. So they'll probably be doing audits on their own, which will be probably good for the industry. But I don't think any of us are like disillusioned in saying like USDC or USDT is a great thing. Like, usually you would get flack if you put that as the backing to your stablecoin or anything like that. Like we all know it's sort of centralized, and I think that's a good thing still. Like we don't look at them like they're one of us necessarily. So like it's as long as you're sort of cautious about it. And, I know as an industry, we at least still sort of want to move away.
Yeah, I can't understand why they don't want to reveal data. Obviously, like, the most basic is you don't want to be front run on your holdings, but also, you don't want to tell the regulators exactly where you're holding your money because they can just go after you, because CZ did that and they whacked him, so I can totally see why people don't want to do that. Actually, there was a thing a year ago that if you're onshore, if you're kosher, it's all regulated, it's going to be great. And a year later, now everyone's setting up offshore entities, Coinbase, I think Kraken too or something. So like, we just learned that basically less transparency is kind of better. And that's not different from last century, I think, where you had the euro-dollar situation where money was created outside of America. Now we have something kind of similar to crypto dollar or something where we create money outside of the United States. So I think, less transparency, funnily enough, is probably better for these stable coins. For us, I think what matters to us probably is just, I feel like with a lot of these stable coins, we don't know what's in there, but we have track records. So I think on the previous panel, somebody mentioned that, like during Terra Luna, like $10 billion or something were redeemed within 2 weeks of Tether. And I'm like, that's quite a lot of money to be redeemed so quickly. And we kind of have to rely on track record at this point while building decentralized alternatives.
Yeah, I think the lack of transparency for centralized stables is definitely it's an unsolved problem. Tether, it's kind of a black box. Like they report quarterly, and you assume, okay, if they're telling the truth, they have enough backing. But it's really tough to assign a probability of what's the likelihood that they're not telling the truth. That's just kind of like a black swan risk. Even with something like Circle, okay, they do probably have enough dollars in the bank and T-bills to back their stable, but you might not know which banks that they're working with. And back in March, for instance, USDC had the DPEG right around, I think it was Silicon Valley Bank that was going under. And my team spent the entire weekend trying to figure out okay, who are they banking with? Are any of their other banks going to blow up? And it's very difficult to find that information. Compare it to the roughly like 40% of makers backing that is crypto collateralized vaults or through Spark protocol. And you can see second by second, block by block, down to the individual position level. And you can see, you know, in our dashboard, you can see exactly how much loan to value ratio each of those positions have. And you can then, you know, kind of model out what's the risk happening for this stablecoin. So I think that's, you know, kind of an area of growth, hopefully in the next cycle, is how do we get that, you know, minute by minute, hour by hour data on centralized sort of backing for stablecoins, for real world assets. How can we actually reliably get that information on chain and be able to use it?
Yeah, I think the other panelists did a great job of covering most of the points I wanted to talk about. The thing I would add too is I think, yeah, since I started working in the crypto space, I don't think a month has gone by without me reading an article about USDT FUD. I think that it's one of the sort of pillars of risk management in the space, understanding how you sort of assign some stochastic understanding of what the risks are with sort of balance sheet opaqueness, right? At the same time, I would also say the point that Monet just brought up as well, like when you take something like Circle, who's making a lot of pushes with sort of cross-chain messaging with CCIP and understanding sort of how to properly mitigate risks across various communication channels. I would even say with them, yeah, like Monet said again, with Silicon Valley Bank, even if you have more information about the balance sheet than you would for sort of other fiat-backed assets, you still hold some risk, right? Like if they hold longer dated treasuries, if they hold assets in a bank that could go under because of sort of external exogenous sort of events, there's a non-trivial amount of risk. And I would tend to say too that understanding those risks and pricing it is obviously always going to be a challenge. At the same time, having the challenges for these fiat-backed currencies be slightly different from the issues we see on-chain actually, I think, as a whole, helps to mitigate the risk because you have less sort of concentration risk, right? Again, being at the whim of the US government and their regulations is not the best, but I think that that's sort of something else that is worth considering and making sure that we were set up as sort of a community for those changes.
Yeah, thank you. So, like we have fiat-backed stablecoins and crypto-backed stablecoins, and like each side has some advantages and disadvantages. So, do you think that are we gonna able to make crypto-backed stablecoins much better so that we don't need we won't need the fiat-backed ones anymore?
Is this where I get to show my stablecoin?
Like, I mean, obviously this question is based on the assumption of crypto-backed stablecoins are better. And I think, I mean, most of the audience will agree on that. Yeah, if not, I would love to hear your opinion. But under this assumption, what do you think? What kind of things could be made in terms to make crypto-backed stablecoins much better, so that fiat-backed stablecoins will be in a way useless? Yeah, just to make this network more decentralized, you know.
Yeah, I mean, I think the problem until recently was that the thinking was always about over-collateralization, which just doesn't scale as much, unfortunately. And the only kind of way to back your stablecoin with non-dollar assets is to, so far that we came up with in the space, is delta hedging somehow. Like UXD, I think pioneered it back in the day. You take Solana, you short Solana perp futures, and you know, voila. But that's kind of the only thing we could come up with so far. That's kind of what Ethereum is about as well, just stake, but using stake teeth and centralized exchange futures. But it's not perfect, but at least you're getting away from the treasury exposure and it's not over collateralized, so you can kind of scale much bigger than what we had before. But I'd love to see any other ideas apart from delta hedged stables backed by crypto assets. Just haven't seen anything that has actually scaled meaningfully. You know?
Yeah, I mean, I can go. I think I think when you look at like centralized stablecoins versus decentralized stablecoins, I have a framework for thinking about like whenever you talk crypto, you need to pay for two things with stablecoins. First, you need to pay for the security. So like with any cryptocurrency, you know, whether it's Bitcoin, you're using inflation to pay for the security, or you're using transaction fees on Ethereum, you have to do that with stablecoins, but now you also have to pay for the stability. So, you know, something in your protocol has to pay for basically hedging it. You know, there isn't really a free ride here, so you're never going to get the complete capital efficiency, perfect competition that you do with a fiat-backed stablecoin. It's really hard, you know, and people are trying to, you know, what you can do is like you can put Steth or you can put, you know, restaked ETH in there, and hopefully, you know, you have all these rewards, but what you're doing is you're just like not risk adjusting it. You're just using that to pay for it. So you know, like I know you guys have a slightly different model, but it's, yeah, so it's not necessarily that you can compete on those levels, but I think most of what we'll probably see is we'll see a split in what are we actually trying to do. Because right now, most decentralized stablecoins, you're not trying to be a stablecoin to compete with Tron, USDT for payments. Like nobody's doing that. You're trying to just basically create a tool for leveraging or, you know, trading.
Structured product, pretty much, yeah.
Yeah.
It's not for payments. Maybe one day.
But yeah, so you know, like I think you'll see these two things separate. You'll have like stable coins, like DeFi stuff for leveraging and going short different currencies, and then you'll have more payment type currencies, which maybe don't need to be as stable, which maybe you can, you know, play around with on the edges, which may be more privacy focused. So.
Yeah, I think I have doubts that a purely crypto-backed stablecoin is going to be able to scale up to like a, you know, sort of global Tether level of scale. Athena is extremely interesting model using like delta hedged perp. You know, you hold spot ETH, or spot staked ETH, and then you go short the ETH perp. There's still like a little bit of over collateralization baked in. Like as an example, if your perp contract lets you take up to 20x leverage. Sometimes they're even higher than that, but then that 5% of your like sort of minimum capital requirement is sort of, in a way, it's over collateralized. So I think perps, in a lot of ways, they're very similar to CDP lending. They just they're able to provide like a higher level of leverage and capital efficiency. So I'm really excited to see whether that can scale up to like a really high number. If it does, you know, I'm sure Maker would be like interested in yeeting some money into Athena or maybe copying that model for part of its collateral base. But I still have like a little bit of doubts that a pure stablecoin is going to scale up, because even if you look at traditional finance, the demand to hold a stable asset is almost always higher than the demand to, you know, leverage long a volatile asset. You know, we've got like prime money market funds and like a whole industry that sort of manufactures like stable-ish assets out of volatile assets, because the demand for stable assets is just so high, and it's really, really difficult to meet that.
Yeah, I tend to agree as well. If you think about this question from the framework of will there ever be a time where fiat-backed stablecoins do not exist, I think that answer is no. Again, it comes down to trade-offs and sort of the utility you want from the assets that are being issued. And I also think that, yeah, as we get to more sort of convoluted and nuanced derivatives and ways to develop crypto-backed stablecoins, I think that the market share of them will increase inevitably. At the same time, I think there probably still will be a niche and requirement for some fiat-backed stablecoin.
Yeah, thank you. This question will be about the stablecoin trilemma. Basically, just a quick recap, the stablecoin trilemma is, I mean, if you want to build a stablecoin, you need to sacrifice one of the followings, like the price stability, decentralization, or the capital efficiency. And we know that some of the models, you know, are lacking decentralization, some of the models lacking the capital efficiency. So like, what do you think the best model is right here, or do you know or have some alternatives solving this dilemma? And we can make the answers here longer because this is an important concept, and everyone wants to solve this issue to make the most efficient and most decentralized stablecoin. So I'm really wondering what your thoughts are here. So we can start maybe with you, Watson.
Yeah, sure. I guess I'm not here to shill any stablecoin. I also think that, and again, I want to preface with the fact that I think my response will probably be slightly biased as well, coming from a sort of more risk-focused framework for trying to understand how to grow stablecoins in general. With that being said, I think that if we look at the corners of this trilemma, I think that capital efficiency is probably the corner that I think that other sort of asset classes can build out the utility for and the functionality for the most easily. So the reason why I say that, and again, I think that this question is sort of framed as how can you develop the ultimate stablecoin? I think that from my opinion, if we look at perpetual futures, if we look at the general sort of cross-chain implications of various asset classes, it probably makes the most sense to look for capital efficiency and build out primitives that allow for capital efficiency in other places, so that the stablecoin utility can be more focused on sort of decentralization and the stability of the asset as a whole.
Yeah, I think we've seen a bunch of different stablecoin models emerge over the past cycle. Stuff like Liquidity, Reflexer, Rye, and then of course Maker and the centralized stablecoins and a few others. And I think competition and people just kind of attacking that problem from different perspectives is very healthy. It kind of like keeps everyone honest. Users can decide where on that spectrum they want to sit. If you really want pure ETH collateral and maybe sort of towards as much decentralization as possible, and you're willing to sacrifice the price stability, then you can use LUSD as a great option. So I'm super happy that there's so much innovation and just people trying stuff in the stablecoin space. I am a little bit biased. I will shill Maker and Dai, but I think to me the most compelling sort of trade-off space there is trying to maintain the most functional decentralization while still being able to reach a global scale where your stablecoin can be used broadly in transactions and can actually compete with the traditional banking system and sort of address some of the centralization and censorship risks that we're seeing emerge more and more over the time. So yeah, I think stuff like making your stablecoin uncensorable, where you don't have a blacklist function, but then still trying to figure out how you can interact with the real world. You can use some off-chain assets as backing. If you can thread that needle where you have the necessary functional amount of decentralization for users, but then you can still utilize some of the non-decentralized backing and other mechanisms to reach global scale. I think to me, that's the most compelling trade-off there. And whether it'll work, still a bit of a question. Maker, as an example, is pretty exposed to treasury bills. So if the US government really wanted to put their foot down, theoretically, yeah, it could be really exposed to that risk. But I think there is a path forward where we can sort of tell our story to the public, and people will demand their right to use a decentralized instrument while still having it be scalable.
Yeah, I think we're in a pretty tough spot as a stablecoin industry because on the one hand, we want to be decentralized, ideological. On the other hand, we have to eventually make money. You know, like when you're 18 and your parents tell you have to get a job, like eventually VCs will be like you have to start making money now, man. Like, and we're getting close to that point. So we have to kind of figure out how to do that. And I think the way to do it is just to live another day to get influence and market share as much as we can so we can set the rules. And that might not look ideal, not super decentralized, not super immutable, but if 10 years from now we can walk in again into the Fed and say, we own half of your balance sheet, like deal with it now, like that could be pretty cool. Like, but you do what Uber did, and for 10 years they were doing crazy shit, and then eventually that became standard. Like, you know, we just have to do guerrilla tactics and try to be as close to our vision, but being practical. So we need to grow to be relevant. That's what I'm trying to say. So.
Yeah, so if you look at current decentralized stablecoin designs, I think probably the biggest limiting factor to kind of beating the scalability trilemma is like, you know, I'm a little biased, but it's probably the Oracle problem. Like, how do you do price discovery on these assets? So you have some collateral in there. How do you tell when it should be liquidated? How do you do this in a decentralized way? Because, you know, oracles are notoriously centralized. And then how can you do it on multiple different assets? It's a really big problem because, you know, it's relatively more simple whenever you have things that have, you know, really big market share, market caps and dexes that you can read prices from. But whenever you have smaller assets, whenever you have off-chain assets, it gets really, really hard to get prices on there quickly. And what happens is if you can't solve the Oracle problem in getting, you know, a price on there quickly, then you have to over-collateralize these things a whole lot, or else, you know, you're going to be under-collateralized in your system. So I think over time we're going to be getting better at solving that Oracle problem. I think we've, obviously over the past 5 years, it's gotten way, way better. You know, like what was the original Maker design? It was, you know, just a multi-sig and you had an hour delay, and it was on one asset even. So, you know, like we're getting better, but, you know, even just some of the bigger risks with doing this, like you have to take into consideration liquidity. So, you know, if you have Steth backing it, how much Steth can you lock into your stablecoin if, you know, 97% of Steth trades on one curve pool, and this is what the liquidity is? How much can you liquidate? So there's going to be kind of a lot of considerations, but I think as we get better at sort of figuring out what a true price is really, really quickly, especially with all of these like hyper liquid assets, and we have more on-chain information, I think that's just going to get better over time.
Yeah, thank you. So we nearly have 2 minutes. Maybe like I can direct if some questions you might have. Maybe one or two questions I can take to direct to my guest. So anyone from the audience have a question to ask about our topic? Yeah, please.
So, oh great. I'm mic'd up already, so that's very convenient. So basically in the last panel we saw that maybe the thing that is important is the velocity of money, how to make sure that there is enough liquidity in this particular stablecoin if it will be used as some sort of payment rails or whatever. Is it like completely obvious a priori that only centralized stablecoins can actually satisfy that? And like, does any of the panelists have any like idea, perhaps in the very long term, how a decentralized stablecoin could have enough liquidity for this particular use case?
I paid for the Ravi ticket with Go, actually. So that was like, that's one. And I'm running out of thoughts at this point. But yeah, to be fair, I do think there's a good case to be made that only centralized stablecoins actually use as pay rails. A lot of people bring up yield from decentralized assets. It's a good reason to kind of use it, but I generally don't think that 5 to 10% is enough. It's all about liquidity. So unless we somehow have an amazing bull market, we can incentivize liquidity and keep it sticky, it'll be very hard to compete with something that's like Tether, Circle. They got armies of market makers, of funds trading it. Like, it's just such a liquid market. It's very hard to compete, in my opinion.
Yeah, I think, yeah, this is also a problem that we looked at with the Aave team with Go in terms of understanding sort of the liquidity bounds that you would need to properly, ensure whether it's liquidations, whether it's enough market participants having sort of assets to facilitate sort of efficient market movement. I think at the end of the day, it becomes a question of how to properly incentivize market participants, whether it's holding the assets, providing liquidity, or even transacting. Because I think that and I think this is a problem that's sort of convex in the sense that as you push adoption and as you push the correct sort of market makers and liquidity providers to step in, it naturally sort of enables more minting, it naturally enables more users, and so I think it's a problem that is definitely important, and I also think that we sort of have the building blocks to solve it already.
Yeah, so awesome. We're unfortunately out of time, so I want to say thank you to my panelists for both being here and also sharing their wise insights with us, and also I want to thank the audience for being here and listening this panel carefully and with a great passion. So thanks everyone.